Okay, let me introduce our opening speaker this morning is Carlos Lara, and I know a lot of you guys know him, but let me just give you some background. We do have new people here as well, so very briefly, let me just explain, what is his role here, and also because he's instrumental in how I got into IBC. So just real quickly, just so you know the backstory. So Carlos, he's the founder and CEO of United Services and Trust Corporation. He's based in Nashville, and he has been counseling and helping business owners and couples set up their financial planning strategies, and he has a specialty in working with distressed businesses, let's say, like people that get into trouble, and especially in the retail sector, and Carlos would come in and try to get the banks off their back and work out solutions for them, and you'll see that reflected in this talk. So he has decades of experience in the sorts of things he's going to be summarizing and generalizing for you here in a minute. How I met Carlos was I was in Nashville, get an email, and he says, hey, I'm using your study guide to Murray Rothbard's economics treatise, and it says on the back, you're in Nashville too, do you want to come over? And it turned out what Carlos was doing, he's explained to me, he was working on a PowerPoint presentation because he was going around, this was 2007, 2008, he was going around to associations of commercial bankers, like they would have conferences in a room full of commercial bankers, and he was going through a PowerPoint explaining how fractional reserve banking worked and how they were causing the boom-bust cycle. And so my first reaction was, are you out of your mind? Why are you doing this? And did you lose a bet? But he was doing that, and he was saying afterwards, a few people would come up and say, we had no idea we were doing that. Thank you so much, right? And so that was part of it, that this isn't, us versus them. It's just a lot of it is education. A lot of people just honestly had no idea that's how the system works. So that's what he was doing. What I took away from that was I was really impressed that the care with which he, was making these PowerPoints. He's reading Murray Rothbard's, and he's reading my study guide to it. He's having me come over, that he wanted to make sure he got it right? So there was a period there, you may remember, some of you, when Ron Paul was running for office, and a lot of business people were throwing around Austrian economics or Mises or Hayek just because they had cachet with certain clients, but they didn't really know what they were talking about. On the other hand, there's lots of academic Austrians who don't know anything about how the financial sector works or business. And so Carlos is one of the few people that actually has a foot in both camps and really gets it both right, I think. And so he's going to be talking to you today about some of those issues. And without further ado, let me bring up Carlos Lara.
The case for IBC. So as ambassadors and advocates of IBC, this is what we do when we talk to people. We make the case for IBC. And so what I'd like to do this morning is to give you a perspective on IBC from the business owner's view. Now, as Bob said, I've been working with all different kinds of businesses for now 4 decades, and they will sell and manufacture all different kinds of products. And what we're doing here is trying to solve a huge financial problem for the business owner. And the kind of work that I do is doing informal reorganizations outside of bankruptcy. And so the idea is to meet with all of the creditors of the businesses and all of his banking relationships and try to get these people to come together to help solve the problem and hopefully get paid. Now, during this period of time, I have spent a lot of quality time with business owners, traveling around, dealing with the business owners' problems. And these assignments are all over the United States, and they will go for 1.5 to 2 years to solve. So during this quality time that I've spent with business owners, I've gotten to understand their personality. So I can tell you a lot of things about business owners. First of all, I respect them very much because they are entrepreneurs and they're the ones that make our economy hum. They're risk takers, okay? So I do have respect for them. Now, I'm not saying they're brighter, more special than anyone else, but they do see the financial world differently. Now, a couple of things about business owners is that they don't really care for financial products. They don't like things like life insurance and long-term care and stocks and bonds and mutual funds. Now, I'm not saying they don't have these things. They're just not keen on them. This is not what they're interested in. Now, they do buy assets, but they like hard assets. Now, here I'm talking about land. They will buy land. They like land. They like brick and mortar, real estate. They will buy real estate. A lot of them like the precious metals. And they all like cash, like the rest of us. But the reason they don't like these financial products is because they feel that their primary asset is their business. They feel that this is where they're going to get the highest rate of return, more than anywhere else. And so this is where their focus is. This is where they spend all their time, all of their energy, all of their money, blood, sweat, tears, just focused on their business. Now, I'll tell you another thing about business owners. A lot of people believe that business owners are long-term planners. They're not. They're basically thinking, next 30 days, how do I get there? Or the next 60 days. What's happened last year is history. It's not important anymore. They're focused on the 12 months in front of them. So they're over here at the beginning of the year, January, February, and they're looking down the corridor of the future of the months ahead to get over here to November, December. If they make it here, their goal is to make a profit. And after all, this is what they're in business for. Now, they know that if they make the profit, they're going to have to pay some tax on it. But after they pay the tax, they're going to wind up with a residual amount of money. And I'll tell you what they'll do with that residual. They will either buy another business asset because it's going to help their business. They'll pay down some debt, or 9 times out of 10, they will plow that residual money right back into the business. Why? Because this is where they get their highest rate of return. This is how they think. Now, just having told you that much about business owner, what do you suppose a business owner's number one concern is? Something that this has got to be coming in every single day without fail. If you're guessing it's sales or revenue, you're absolutely correct. This has got to be coming in every single day without fail. Why? Because every single day he's got money going out the door. He's got to pay expenses. And if those sales are not coming in, he can't pay them. Now, just right here, if you're not a business owner in the audience, can you not relate to this? That paycheck's got to come in, or you can't pay your bills. Same thing with a business owner. What do you suppose the business owner's number one expense is? Now, if you've guessed that it's payroll, again, you're right. Payroll is a business's number one expenditure. This is why when their industry goes south or there's a recession, the pink slips come out. They let go of people because if they don't, the sales are going to be declining, and this expenditure alone will eat up the company. What do you suppose the business's second biggest expenditure is? It's rent. Rent. The space where the warehouse is, the locations, the various branches. That's the business's second biggest expenditure. Just with these two expenditures could be as much as 35% of annual revenue, just with these two. Now, the business has other expenses, of course. We can all just guess it's a long list. He's got to pay insurance, he's got to pay utilities, cell phones, lease equipment, all kinds of things. And so this is why these sales have got to be coming in so he can meet all of this. Now, there's another item that's very closely related to sales and revenue, and something called accounts receivable. Now, accounts receivable, this is when this business sells products or services to other entities on credit. So they have time to pay, maybe 30 days, 60 days to pay the invoice. And not until they pay that invoice does it get added to sales. So businesses will have an entire department with a credit manager just devoted to looking out for these uncollected funds because they could represent hundreds of thousands of dollars. And one of the reasons why he has a whole department looking after these is because these things tend to get late. People will ride that dating. If they get too late, they go bad. And so it's not unusual when somebody gets way out here at 120 days or 180 days that the business owner himself will pick up the phone to call that delinquent account, find out where his money is. If you're a business owner in the audience, you ever done something like that? Yeah, I have. You pick up the phone to find out where your money is, and 9 times out of 10, you get a weather report. I'm serious. Carlos, it's you. Oh my goodness, you wouldn't believe it. The skies opened up. I mean, we got dumped on. 15 inches of snow. We're buried here. The whole city's shut down. Nobody can move. But hey, as soon as the things thaw out, that check's in the mail to you. You don't get your check. You get a weather report. That happens quite often. Now, business owners, above all people, realize that sales don't always go up. Sometimes they go up, sometimes they come straight down, then they go up again, then down again, and sometimes they're just plain flat. The reason for this volatility is because all businesses are seasonal. That's right. All businesses are seasonal. They will do more business in certain months of the year than in other months. It doesn't matter what kind of business it's in. You know, there are some businesses that will do 60 to 65% of their entire annual sales in the last 60 days of the year, these last 2 months. How would you like to be in a business like that, where you're running flat most of the year And then you have to make it all up in the last 45, 60 days. What happens if you don't make it? Disaster. And that happens quite often. It's disastrous. Now, there's one other item that the business owner is very concerned about paying on time. And this is an item known as accounts payable. Now, accounts payable, these are the suppliers of the business. They ship merchandise and products to this business. And the thing about these accounts payable is they ship it to the business on the very same basis as this business ships these guys on credit. So the business has time to pay on these invoices. Now, business owners view these suppliers, these accounts payable, as very important people. And the reason is because the dating that he gets on this, okay, that's a form of working capital for his business. Financing. He can receive the merchandise and have time to sell it before he has to pay for it. So he wants to make sure that he pays these guys on time because he wants those credit channels, opened up at all times. He doesn't want to run late with them. Now, I'll tell you one thing about these suppliers. When these suppliers ship inventories, merchandise to the business, the minute that merchandise hits the warehouse of this business, the title to that merchandise changes hands. It's no longer the inventories of the supplier. Legally now, it is the merchandise of the business, even though he hasn't paid for them. So in the line of work that I do, I refer to these guys as unsecured creditors. Why? Because they're shipping merchandise with no collateral. It's open credit. So what these suppliers have to do constantly is monitor the financial well-being of this company. They need to be looking at financial statements and balance sheets to make sure that this business is still creditworthy for them to continue to ship them product. Now, just stand back and look at this for just a minute. Do you see this business owner is taking money from here and paying over here and going over here, sometimes robbing Peter to pay Paul? Being in business for yourself can be nerve-wracking. It's not for everybody. It's not for everybody. This is very challenging to be in business. He's got to deal with all of this. Stressful. Business owners know that more important than profit and loss, more important than the assets and liabilities on a balance sheet, is cash flow. Cash flow is king. And he sees his primary role as a cash flow manager. He's in cash flow management. That's what he's doing all the time. And when businesses get in this kind of situation, this is why you see they generally reach out here and engage the services of a commercial bank. And the reason for that is because commercial banks are in the business of granting lines of credit and loans, which, by the way, is what they do. And so the business owner gets at a point where he says, you know, I've got so much volatility going on with my cash flow, and I'm going to need the services of a commercial bank to help me out with that. Now, you might think that's a difficult relationship to get started, but it really isn't. That bank is waiting for that relationship to happen. And the business owner may approach someone he goes to church with that he knows is a banker, works for such and such bank, or maybe it's a guy he went to school with. And so, yeah, the banker says, oh, Jim, great, I want to do business with you, of course. Be glad to help out. Now, because we're going to be working with you and we're kind of partners in the business now, the only thing we request is you make sure that all of your revenue goes into our bank. So all your deposits are made here with us. Now, Jim, the business owner, may think, well, that's fair enough. I mean, I need a safe depository for all my funds to go into. No problem. So the minute this is set up, the business owner now begins to tap that line of credit when he most needs it, and now he's using the line of credit. But now the business owner has a different goal. It's not so much this one, the profit. He now wants to make sure that when he gets to the end of the year, that he pays off that line of credit. That becomes his main goal. Now, why would that be? Well, because he'll want to use that line of credit next year. It needs to be there for him to continue to operate. So that becomes his main goal. And as long as you've got a business that is operating this way, the business owner is paying off that line of credit at the end of the year, the banker is very happy, the business owner is very happy. So what do you think happens if all of a sudden he has a bad year? It happens. And he's not able to pay off that line of credit by the end of the year. What do you think is going to happen? Well, he's going to get a call from his friend at the bank. He say, you know, Jim, you didn't quite pay off that line of credit. It's no problem. Tell you what we're going to do. We're going to set up a short-term note, okay? You know, not too far out there, but you know, short enough where you can deal with it. Let's say a year. So we write out a note. You'll have 12 months to pay. And come on into the office, sign the paperwork, and you'll be good to go. Does that sound okay? Now, Jim, he's already got an uneasy feeling about this. He's mad because he wasn't able to do this. He doesn't really have a choice, so he goes with it. He signs the paperwork. He comes back and he starts to realize, you know what? This is another bill I've got to pay now. I've got to pay terms, you know, principal plus interest. And you know what? I got to make it on time. And not only that, my line of credit has been reduced by the amount of that note. This isn't working in my favor. He vows to himself, this is not going to happen next year. I'm cleaning up that line of credit. I'm going to clean up this note and this line of credit. I'm not going to allow this to happen. But what happens if that doesn't happen? Supposing there really is a recession. You know, during the big recession we had, there was a lot of this going on. Well, he's going to get another call from the banker and say, you know, Jim, not only were you not able to pay off the note, but you didn't finish up on the line of credit. You know what? Don't worry about it. Okay, it's not a problem. We're here to help. How about if we extend this first note for another 6 months? And then we'll just do another note for the amount that you were not able to clean up on the line of credit for another year. Does that sound okay? Well, it's not okay for Jim. This is not a good scenario for him. But he couldn't fix it. There is a recession. Or it could be the industry's not doing well. Whatever the reason is, he knows this is not a good situation. Besides, he's beginning to realize that every time he goes in to sign this paperwork, the bank is taking liens on all the assets of his business. That's right. And not just liens, blanket liens, which means in a sense that the bank is over-collateralizing themselves because they now are getting more collateral than what they're really owed. And they're taking them on all the factors of production for you economists out there. They take it on land, on labor, and on capital. That lien applies to all three of them. Now, what do we mean by land? Well, land, you know, where the business is, where the warehouse, the locations, the branches, they got it. The property of the business. And not just the real estate. This reaches over to all the assets of the business. They got the accounts receivable too. This could represent millions of dollars. And not only that, they got all his inventories under the lien. Even the inventories the business hadn't even paid for yet, they got them. Now, how do they take a lien on labor? Does that mean the bank takes a lien on all my employees? No. This is you, the business owner. And that's through the personal guarantee. Because this is how banks pierce the corporate shell, go right to the business owner's personal assets, which includes his home, his residence, and anything else he owns personally. They got it all. Capital, remember what Ryan said? But capital, in this sense, we're talking about equipment in this sense. Equipment, all the equipment comes under the bank's lien. Equipment, furniture, fixtures, it's all under the bank lien. Well, as this is happening and the business owner sales are going down, what do you think these guys are doing? They're examining the financial statements and they're realizing there's a bank involved now, and every time they ship in goods that's coming under that bank lien, they start to pull back credit. Well, the business owner at that point is in a death spiral. His main goal right now is somehow or another coming up with a big pile of money to get this bank off its back. That's hard to do when you get in a situation like this. Not easy. But if he doesn't do it, this business is going to go down. Now, if this happens again, the business owner is not going to get any more calls from his friend at the bank because this file's been turned over to another department now, the special assets department of the bank. And Jim doesn't even know these guys. He doesn't have any relationship with them at all. And they're not thinking about helping Jim. They're wanting to get out of the situation. They want to be paid. That's all that bank is interested in right now, is getting paid. Now, you think that's hard for a bank? Not at all. How do they do it? In bankruptcy court. That's how banks get paid. Bankruptcy. Now, why is that? Well, because in bankruptcy, the bank is the secured creditor. Everyone else is unsecured. And I'm sure you can see that by now. I mean, they're controlling his entire cash flow, and they got a blanket lien on everything. They're secured. So the bank needs to put this business into bankruptcy to get paid. Can they do it? Is it easy for them? You bet it is. They can do one of several things. They could foreclose. That'll do it. They could call the notes. That'll do it. Or they could put the final stranglehold on him. Cut off his line of credit. At that point, he's done for. The business owner seeks now protection in bankruptcy by filing a Chapter 11, which gives him 180 days to come up with a plan to get out of this mess. What's the plan? He's got to raise the money somehow. Really hard to do when you're in bankruptcy. If that 180 days goes by and he's not able to get that money, then the bankruptcy court is going to adjudicate this business into a Chapter 7, liquidate the assets under a fire sale, and the bank will get the first proceeds on the sale of those assets. They'll get paid 100 cents. Everyone else is going to wind up getting pennies on the dollar. Now, who are them? Well, the stockholders of the business, Jim and his associates, and these guys, the unsecured creditors. Now, at this point, as I'm talking to audiences, I'll get business owners say, you know, Carlos, I don't disagree with any of this. It's true. I've seen this happen. But you know what? I've been in business 30 years. I've never had this kind of situation. You know, I never had this kind of situation. But I'm not disagreeing. I say, they happen weekly. So what are you suggesting? I'm suggesting you take every available cash flow that you have, any excess cash flow, and you use it to set up your own private alternate bank. Every available cash flow, sweep it in here, get it started, because this bank will mimic and do everything this other bank will do. It'll give you lines of credit. It'll provide you loans. It'll do the same thing. You need to set this up, begin to wean yourself off completely away from this commercial bank. This bank not only gives you loans and lines of credit, it also affords you tax benefits. Well, you don't get that over here. On top of that, this bank of yours also pays you in the form of interest and dividends. You don't have that happening over here. Better still, the terms on the repayment of these loans are so flexible, there's nothing like them in the entire financial world. Nothing like them anywhere. Because the business owner can pay them back on his own schedule, when he wants, when he can. And I'll go as far as to say, if he chooses not to pay him back at all, he can even do that. On top of that, no liens on any of the business assets. That's freedom. You don't have to deal with this mess. Again, the business owner will say, wow, all right, you're wanting me to break my relationship with the bank, but I'm telling you, I've had a great relationship with them. I mean, I'm doing well, but you know, this thing over here that you're talking about, I'm intrigued. Never heard of such a thing. Where's it come from? And I say, well, it doesn't come from the commercial banking sector. It doesn't come from Wall Street. It actually comes from the insurance sector. But I want you to make sure you're hearing me, because I'm not just talking to business owners and them getting away from the commercial banking sector. I'm talking about everybody. Because being a depositor, just being a depositor in a commercial bank has gotten riskier than ever. And why is that? Well, because of two laws. Two laws. Now, the first law, it's been in this country since the country was formed. It came from England, and so our banking system just absorbed it. Now, nobody's ever paid any attention to it. A lot of people don't even know about it. But when we had the 2008 financial crisis, some people started to wake up to that law. Because here's how that law works. Now, I know that these days, most of us make our deposits in commercial banks without going inside the branch. We do it all electronically. It's easy, it's fast. But there's still millions of people that go through the drive-through. If you're a business that takes in a lot of cash, you'll go through that drive-through 3-4 times a day, several times a week. Many people go through there to deposit their checks. And they all do the same thing we do. You roll down the window, stick your hand out, pull out that plastic container. You all know what I'm talking about. And that's where we put our checks and our deposits. Drop it down that tube. Shh. Sometimes, you know, that tube is transparent. You can see that canister just flying. Wow, goes over there to the teller. It's really, they take your money so fast. The moment that teller puts her hand on that canister, the title to your money changes hands. It is no longer your money. That money now belongs to the commercial bank. That is the law. And they can take that money and they can gamble it away if they wish. Now, they do owe you the money, yes, but legally, it is now their money. See, you thought you were just putting in there for safekeeping. Hold on to it until I get ready to pay my bills. No. They now own the money, and you are nothing more than a creditor of the bank. That's the law. Now, what's made that law even uglier is on account of another law. Now, this law was ratified in July of 2010. It started being formulated by Congress after the 2008 financial crisis. It's got a long name. Its short name is the Dodd-Frank Act. For several years after it came out, people didn't even know what it was. I don't blame them. The document is over 1,000 pages long. Who would read the thing? If you understand bankruptcy law, you can read it. I read it. There's a lot of reasons that they put that law in effect. One of them is because when the 2008 financial crisis hit, people fled the investment markets. And when they fled, no one would come back because everything crashed. All right, they just didn't want to have anything to do with investments again. They were that scared. So the law was to bring them back into the markets. Another reason for the law is because they wanted the too-big-to-fail financial institutions to bolster up their reserves. And the third reason is that they develop an expedient way to liquidate these too-big-to-fail financial institutions if they should fail again. A way to liquidate them. Why? Because Congress declared in that law that if we have another financial crisis similar to what we had in 2008, there will not be any taxpayer bailouts. They will not do that again. They'll probably have riots in the streets if we do that again. What they will do instead is this. If your bank fails, they'll close that bank down and sequester it. No money will come in, no money will go out. Then they're going to have the officials come in, Federal Reserve, SEC, FDIC. They'll pool together the money of the stockholders of that bank and the monies of the creditors of that bank. Who did I say the creditors were? The depositors. They'll take that money with the stockholder money, pull it together, and they will attempt to resuscitate that failed bank. That's how they want to deal with it, because when these too-big-to-fail financial institutions fall, not one of them falls. A bunch of them fall, just like falling dominoes. They pose a systemic risk problem for the whole financial system. So this liquidation process deals with that. Now, thank God we haven't experienced that kind of bail-in, but we've seen several examples in Europe. The first one was in Cyprus in 2013. The people in Cyprus woke up one weekend morning, getting ready to do their weekend shopping and dining out. They go to their ATM machines. They can't get any money out. It spooks them. The branch is closed. They get in their car. They drive over to the main headquarters. It was the largest commercial bank in Cyprus, and what they find there is a huge crowd of people. They're all there for the same reason. They want their money. But the bank is closed. There's a sign on the door and said that it was closed until further notice. And do you know that they stayed closed 12 days? 12 days. They were shut down. Can you survive without getting to your cash for 12 days? How do you make payroll? How do you pay your expenses? And this is why during that 12-day period, many businesses in Cyprus failed. When they opened the doors again, some of the depositors got all their money back, the smaller amounts. The rest of the depositors got one of two pieces of paper. One of them was a promissory note saying that they were able to succeed in resuscitating the bank, they would see their money back, or they got a stock certificate, a stockholder in a defunct bank. Now, when it all played out, the bank failed, depositors lost 85% of their money. And we've seen several cases of this. So, again, I say, take every available cash that you can and set up this alternate bank. Wean yourself away from this as quickly as you can. We have another crisis coming. Now, at this point, people in the audience raise their hand. Carlos, I don't know that I have to be, I've got the FDIC. Seriously, they will jump up and say that. I don't argue with them. They do. They have the FDIC. But I don't want anyone to be naive because we all have a short memory. During the 2008 financial crisis, we had 1,200 banks that went underwater. 1,200. There's only around 3,600 commercial banks in the whole Federal Reserve System. 1,200 of them went underwater. So yes, ma'am, yes, sir, the FDIC was very busy, shoring up bank accounts, going around all over the country. They ran out of money. The FDIC ran out of money. At one point, they were $25 billion in the hole. The only way they were able to shore up and pay everybody depositors was to go get a loan from the Treasury Department. When we talk about the FDIC, that's where the federal comes from. They have a line of credit to the Treasury, but Dodd-Frank says no more taxpayer bailout. So I'm not sure you have the FDIC. Besides, when I last checked, if you look at their website, I think it was in October I checked, the FDIC had $88 billion, which is a pretty significant sum of money to deal with bank depositor money. And I'll give it to them. This is twice the amount of what it was in 2008. So they've beefed it up. But the total of U.S. bank deposits, the ones that they are insuring, is $7.1 trillion. So I like to tell people, I would just like for you to just look at the disparity between these two numbers, 88 billion to 7.1 trillion. For those of you that are good with a calculator, you can do the math. How much, maybe they have, FDIC has 1%, enough money to cover all of bank depositors' money. If you have money deposited in a commercial bank, you are a creditor of the bank. And yes, you've guessed it. You're unsecured. Thank you.